So one of the things that we wanted to talk about when we looked at what happened on Monday when the market, really kind of fell apart, it's really important to look at what really drove that and what some of the issues were. And when we look at retail investors, and this is something that we've been talking about for the last few weeks, was that a lot of margin had been consumed and utilized. So when you look at what had been consumed and utilized, it was much harder to see who was going to be that dip buyer. Now, obviously, we've had people coming in, and we've had some decent updates since Monday. It became a much bigger issue because a lot of people were were already levered in, and that became margin calls, which is why when you look at 2 p.m., all of a sudden you saw this acceleration to the downside because people got margin called. They either had to put up money to make the difference, or they were left holding the bag, and then the company, with whoever they use, would push them in. So this became a much bigger issue over that time period. And here's where, when you look at what the retail investor purchases of US ETFs, and it's starting to get a little bit slower just because there's people are already long, and it's hard to get longer given we have YOLO calls, we have all this fun stuff. But again, we're starting to max out in terms of kind of where some of this capacity is in general, which is going to be something to watch as we go through the remainder of, really the remainder of 2021, into 2022. Where are people invested? How are they invested? And what is that going to look like going forward? So then when we look at activity, so day trading making a little bit of a comeback, and it's how are people day trading? And I think, something that I've talked about and I've invested in over the, taking advantage of it is our leaps, or these long-term calls, if you will, because with the market that has only gone up, volatility gets cheap. And if you have something that you're really confident about, but you're not really sure about timing, you can go out and purchase those leaps. So you're starting to see day trading again, still staying strong, still starting to come back in, but you're starting to see some of that ebb and some of that adjust, especially as the volatility has picked up a bit with some of the pressure points that we've seen within Asia. So then when you look at what becomes a drag, and we've talked about this multiple times, and I think Bloomberg put out, a source from a Bloomberg article, put out a really good chart in terms of, the U.S. government spent what their historic amount on, and what is that going to mean for that policy impact? Because remember, a lot of that gets pulled forward. So you have a lot of this getting pulled forward, and you see a lot of these pressure points that come through that create a much bigger issue when you go, as you expand. And so then it comes down to CapEx, it comes down to inventories. So inventories and CapEx should be a little bit of a bridge and help support some of that spending. But the consumer, a lot of that has been pulled forward. And as the consumer has been pulled forward, you're not going to see the same type of spend, which again is going to become a much bigger overhang over that time period, which again is I think something to consider when we start looking at GDP growth over that time period. So then when you look at the Treasury at risk of default, and so this is when we get to the debt ceiling, because as we get towards the debt ceiling, so you have the extraordinary measures that have been kicked off. A lot of that has expired, but there's still a cash balance, and you have to maintain that cash balance to pay bills, to pay interest, to keep the system moving. And based on just where we are right now on that spending pattern, it will start getting to the end of it by into a negative territory by the end of October. Now, there's always cuts that come through, things that get delayed, payments that aren't made, and then that helps bridge that gap. So even though theoretically it's the end of October, that can get kicked into the middle of November. But again, it doesn't matter, because that's when you start getting a government shutdown. You start getting into all these issues in terms of raising that borrowing limit and trying to fund the government, which, as we've been saying, is 43% short. Close to 43% short of budget and needs to be borrowed. And this just puts it into perspective of just how quickly the cash came in, when you look in March and then that cash coming back out, and you can see that we're now back to levels that we haven't seen since even before 2019. But when you do those extraordinary measures, what does that mean? So U.S. non-interest payments due October 15th to October 29th. So these are things that can get delayed or just go on back order, if you will. When you look at payments for Medicare, Medicaid, SBA, Social Security, these are payments that just won't be made in order to prolong that cash balance and enable some of the debt to be serviced and to avoid any kind of structural default, which is a much bigger issue on its own right. Now, when you look at the consumer, and this is something that we've tried to talk about when you look at bank deposits in terms of who has the bank deposits, because this looks great. This looks to something where it's like, oh, well, look at all this cash sitting on the sidelines. Well, we like to look at, well, how much of that cash is usable, who has that cash, and how can it be disseminated? And again, you see something a bit differently in terms of where that spare cash is and how much can be pushed into the market. But there is some of this hope that the consumer is going to pull some of this down, deploy it. But then when you look at the consumer, inflation is up. A lot of their costs are up, which again is weighing into what some of this overhang will be over that time period. So then when we look at, well, the Fed has come out, they're keeping rates. What it looks like they're going to keep rates flat through the end of 2021. But I mean, at least for myself, I never really thought they were going to raise rates just because you still have QE. Like, how about you stop QE and then start raising rates? So I think that's the next thing to come. And this is when we look at the Fed reverse repo program, when you look at the amount of money that's been put into the market. And then, now we are consistently above $1.2 trillion that's going back and forth between the federal bank balance sheet and the bank balance sheet. So you continue to see this pushback and forth, which again is weighing on where things are going, how things are progressing. And this is, I think, a much bigger issue in general, which is just showing how much cash is in the system and why we should see a very aggressive QE taper to avoid this continuing to push through and be the overhang. And then when you look at the U.S. ISM manufacturing and Philadelphia Fed leading lagging parts, when you smooth things out, you're just seeing just how slow things have gotten, how the overhang continues to come through. And this is when we start looking at GDP growth and what that growth can really entail and the pressure points that we're going to see over this time period as we progress through the system, through the remainder of the year. And again, these are things that I think when you go out through time, and then because this is also obviously going leading by 10 months. So now we're into 2022 and you see that continuous slowdown, that continuous overhang, and then you layer in inflation, you layer in some of these misses, some of the struggles that are going to come from it. That's when, how the Fed needs to start taking away some of these things so that it can get redeployed if we do start to see a more aggressive slowdown, as the difference between hard landing, soft landing, as we've discussed in previous times. But right now, it's not a cash issue. There's no liquidity issue. There's more than enough cash in the system right now. It's just, where does it sit? How is it being used? How is it moving through the system? And the inflation that is overwhelming. So then when you look at the Philadelphia Fed Business Outlook survey, you can see that it's still elevated, still moving along. And then the Business Outlook survey, number of employees starting to come down a bit, but still elevated. So there's still some benefits. Like, we're still going to see growth. It's just going to be a matter of how measured is that growth going forward, given some of these overhangs. And then when you look at the Philadelphia Fed manufacturing expected activity in 6 months, you can see that activity is expected to slow. New orders are starting to come back down, which is when you look at new orders, you kind of know what's coming, what to expect. And those overhangs are continuing through the system over the next 6 months. And again, this is what we're seeing with some of this slowdown in general. A mixture of this is supply chain issues, not having enough equipment, and then also obviously on that demand side. So that's why when we look at the expected orders, the new orders, the CapEx expectations, you can see that slowdown. And that's what they're looking at when they're looking at over 6 months, when they're looking over this time period and how this is going to impact things going forward, and again, acting as that overhang that we discussed. And then when you look at, again, current prices, and this is, again, slowdowns in terms of, well, my prices are going up. So if my prices are going up, how much of that can I pass through? And at what point is there essentially the consumer yields, which is when what we're going to talk about more in segment 3, when you look at just how the consumers is starting to balk at these prices, which then puts pressure on prices received. As you can see that we're back up to 2008 levels, but how much of that can continue before the consumer essentially says enough is enough, I have to stop. And then you look at how the jobs have changed, how people have changed, and what are the most desired aspects of a new job. Well, 31% said flexible work location policy, and that continues to grow, which is where we start getting into flex schedule, work from home, and the different shifts along those lines in terms of what has happened over that time period. So then when you look at the percentage of employees who work from home over the past 4 weeks, you can see that it's slowly coming down, but still remaining elevated. And that's something where the Delta kind of got on the way of that. Some companies have kicked it now into January of 2022. So you're starting to see some of this longevity, which comes back to the EIA show, the energy demand, when we look at oil demand, gasoline demand, weekday versus weekend, as the things continue to pivot on that level. So then when we look at leisure and hospitality job seeking, you're starting to see some of the job seekers coming back, and you saw some of the slowdown starting to come back. So we will see, again, a positive jobs number. The question is going to be how much of it is going to continue in September and then into October, or are we going to see a bit more of that slowdown? When you look at that spending and then you look at the job side, you're starting to see some stickiness where, when you look at September of 2020, you see that there was an increase into September, and then things leveled off and started to come down. But here, when September of 2020 was a downswing, where here, September 1st, 2021, we're on a slight upswing steady. And I think that there's a lot to be considered and looked at when you look at some of this stability going forward as we go into retail sales and some of the sales in general, as jobs start to change and people get more comfortable with what is available and living in this new normal of flex schedule, work from home. Now, this is another one when you look at job seeking, because I think this is job seeking and recruiting slowly improving in September. So the hope is that this is going to be indicative of a good or at least a steady jobs number in September, and then one that can continue into October, helping again to move through some of these new jobs and get people employed again. Now, just to look at, and the reason why we talk about consumer sentiment, how are they spending, that's going to mean if people are spending, then companies feel a bit more comfortable hiring. If you feel comfortable hiring, so they kind of go hand in hand when you're looking at this going forward. And then when we look at job postings mentioning remote and on-site, remote is now mentioned 77% of the time, and on-site is mentioned 25% of the time, just to give you an idea of that work-life balance. And this is for new jobs. So if you sign something for a new job, are you really going to go and take something that is much less? So then when you look at it, retirements have picked up, but partly due to lack of retirees returning to the market. This is something that is continuing through this time period, and we see in the excess side of the equation as we pull forward, as we push things through, you're starting to see the shift in general. As we see 1.19 million excess retirements, that's going to continue to push, and that should open up some opportunity for some younger individuals to move up in that hiring scheme of things. But when we're looking at wages, some of these people retiring are in their upper 50s, low 60s, mid 60s, and they've been at a place for an extended period of time. They commanded a certain wage, but now when you're hiring someone who may be in their mid 40s, are you going to pay them the same that you paid at 65? So that's when we keep talking about wages and how wages keep moving down at the upper end of the scale, which again is taking, you're seeing some of these trends in general. So then when we look at, going into now the real estate side, what is real estate saying? So when we look at home builder traffic, along with an uptick in broader homes, builder sentiment, prospective buyers component has also seen a slight increase despite sizable rollover. So we've come down, we're still at highs. And it's something where people are still looking. There's a little bit of a balk on price, but you're still seeing some of this activity. Then when we look at U.S. existing home sales, you can see that it was a bit of a miss. Things were negative. U.S. existing home sales month over month were down 2%. You're starting to see some of this cool down. People are still looking. You're still seeing buying. But again, we're just starting to see some of this slowdown, and it's slowing versus estimates. And we are seeing an increase of multifamily starts versus single family starts as more families come in, more families look to do to start back up, and you're starting to see some of these things come through in general, and that will be good for longer term when we think about rents and we think about capacity, but it's going to take time to build and get some of these multifamily units out there. But still, and again, coming to the backdrop of it, Redfin Home Buyer Demand Index is still up 27% versus 2020. So even though we are seeing a slowdown, it's still from a very high level, which is something that continues to be in the market in general. And then when we look at the national home builder market index, so slight uptick for September. Builder sentiment was 76 versus a 74 estimate and 75 in prior month. Single family sales at 82 versus 81 prior. For future single family sales unchanged. Prospective buyer traffic up to 61 versus 59. And again, material costs easing a bit, but delivery time still tough. But at least on the material costs, you're starting to see some of that slow down. And then solid increase for August building permits was up 6% versus an estimate of down 1.8% and 2.3%, positive 2.3% in the prior month. Housing starts also stronger at 3.9% versus 1% estimate and at a negative 6.2% in the prior month, revised up from negative 7%. So again, still kind of hanging in this level in general. So then when we look at national single family rent index year over year percent change up and out. And this is something that we continue to talk about as being a big driver of this inflationary push when we look at CPI calculation and how that is going to continue to move up through the system. As we can see here with the July jump in rent on U.S. single family homes surged the most since 2005. Again, a lot of this is going to continue to keep that base and that stickiness within that inflation calculation in general, which we're going to talk about more in the next segment and provide some of that backdrop in terms of what is happening in inflation, how much of it is sticky, how much of it could be considered transitory, and where should that show up over the next few months.